Good evening, all. Welcome back to our monthly Market Outlook webinar series, where we provide a comprehensive perspective on markets and investment strategies. So, we are pleased to have with us Mr. Aman Chauhan, who's a senior fund manager at Abacus. He currently serves as a fund manager and with over 17 years in the investment industries. Before joining Abacus, Aman managed local and offshore portfolios at Reliance Mutual Fund. He also holds an MBA in finance and a bachelor's degree from Mithibai College. We request your kind attention during the call and encourage you all to have questions ready for an engaging and insightful session. Over to you, Aman sir.
Sure. Thanks, Ashwar, and good evening, everyone. Thanks for joining in today. Uh, this is a monthly update, so let's be very, you can say, relevant as to what exactly is the market scenario and how we are things shaping up in the near term. So we won't be discussing much of long-term macros, but more specifically as to what are the events, trends going on. So in the previous interactions, we had mentioned that as far as the market outlook is concerned, there were two things. One, domestically, we were expecting things to pick up, the economic growth rate to pick up. Second quarter of last year, the GDP was 5.5, which was a 7 quarter low. And that GDP is, as we speak today, has already picked up to 7 odd levels. And we were thinking and we were expecting that the current festive season, or the Diwali season of the current year, the demand situation should be much better than the previous few years. Obviously, buoyed by the tax cuts initially in Feb and then the GST cuts, which happened in September. Based on that, whatever initial feedback that we have received from the corporates and whichever industries where we see uh, monthly data coming in, the festive season has in fact done well. Bearing a few segments, say for example, because of extended monsoon or because of some reason, things have got disrupted because of the tariff issue. But if you see overall, on a monthly basis, things have started to look good. So what you see on the screen is the industry data. You see the latest month, uh, the growth is much higher than what it was in the previous month and what it was in the previous year kind of thing. Auto sales obviously went up because of the GST, logistics, trade data, they're all trending up versus what it was the previous month or 2 months back versus also the last year data. So this clearly uh, signals that the consumption growth in India has started to pick up. The key factor now is that post Diwali, how the momentum sustains. And so far, whatever feedback we have got is that the momentum seems to be sustaining. Obviously, the Diwali monthly run rate cannot get repeated, but on a YoY basis, is there a good enough growth, high single digit, low double digit, mid double digit kind of thing? So the answer for that is yes. So clearly, domestically, economy seems to be much better than what it was 6 months back, 9 months back, and that is what is fueling our optimism in the markets. We also discussed last time that the risk to the market is predominantly global. Locally, the markets are doing well, and we all know about the global risk, which is basically the Trump tariff issues. Now, enough has been said, discussed about the tariff thing. It has got further delayed due to various reasons. But if I have to share the latest news and data, looks like we are at the verge of concluding on the tariff details. News has started to come in positive. It is likely that maybe in the next 1 week or 2 weeks before November end, India and US will be able to conclude on the tariff. Now, whatever the tariff number is, I think the industry will take it positively because that ends the uncertainty. So whether it is good, bad, or ugly, whatever it is, at least for now, people have, like you can say, fed up trying to wait for this tariff issue. And now, whatever the number is, it's going to be something which is people are looking forward to. Most likely, it is not going to be a much higher number because we all know that the 50% tariff, which was initially announced, uh, which was 25 plus 25, nobody believes that this is the final number, this is the sustainable number. No investors, locally or globally, expected that number. So when the final tariff number comes in, and if the final tariff number is anywhere between, say, 15 to 18 or 20%, market is going to take it positively and market can even react positively. And we can have a small rally if the final tariff number is below 20. If it is beyond 25, 30, even if it is 35, market might take a small beating because markets are not prepared for that number as of now. Why it is not prepared? It's not prepared because this number has to be looked in a relative basis. If you are taxed at 25 and all others are taxed at 15 or 20, then your competitiveness goes down. Right? Others will be much more cheaper to export to US than what Indian economy, Indian country, or Indian companies would be able to sell in US. And that is going to be a sentiment dampener from as such. Uh, we don't know the final number. We know for sure that it's not 50, but what the final number is something which is on the news flow suggests that it is going to be below 25, which is something which is a good number to have in that sense. The 6 9 month old back expectations that the tariff in India is going to be significantly lower than others, and Modi and Trump get along well, and India will be a preferred nation. That unfortunately is not panning out. So looks like the tariff in India will be comparable to the peer group, which I believe is still good. As we speak, export to US are in a standstill wherever there's a 50% tariff because nobody will pay 50% tariff and export to US. You make 10, 15, 20% margins, you pay 50% tariff, and tomorrow the final tariff is 25%, your 1 year profits are gone. So nobody is taking that risk, and there is no buyers also at a 50% higher rate. So the business which is in standstill hopefully will start to come back. Now, in case in if there's a last minute change and this tariff decision gets delayed, then hopefully it should get concluded by early December. If it doesn't happen, then by 15 December onward, the US government and everybody there goes for a Christmas vacation kind of environment, then nothing moves in US. And then effectively we are talking that in this January is when the tariff decisions can come in. That is too long an uncertain period. Market is not going to take it positively, or market is going to react if we are not able to conclude by November end, or worst case by mid of December. Nobody is going to wait till January end. So this is broadly what the tariff situation is. Uh, things are fluid. Till last week, things were neutral. They have incrementally got positive. What the final number is, even we don't know, because we all know the way Trump has been tweaking on these issues. On Monday, he says something, on Tuesday, he says something else. So it is very difficult to predict. But net, having said that, this is a global event wherein we as investors have no way to judge, no way to preempt. The only way that we can do is we can react. So whatever the number is, we have to react. I cannot in my portfolio preempt that the number is going to be very good and get very aggressive. At the same time, I cannot prevent that the number is going to be very bad and hence become very defensive. Whatever the final number is, we have to react according to that. Yes, we can take certain steps like avoiding sectors like textiles or some capital goods companies or companies which are heavily dependent on US, or favoring more of pharma companies where we feel the tariff number should be much lower, or where better or companies have in a way pricing power. That all decisions we do take, but nevertheless, that's not something that is going to move the needle in a big way. Ultimately, there's not much that we can do. Having said that, today we are much more positive on the market than what we were last year. Last year, since there was economic slowdown, things were earnings and corporate good profit also was subdued. We are not so positive in the market than what we were today. So today we are much more positive, though we are not aggressive yet. We are also hoping for the net number to look at. And this is what the market itself has been doing. Last 1 year, there has been a some one, sorry, in the last 1 month, there has been some pickup in the Nifty. You see a 5% return of Nifty in the month of October. But you see that in the last 3 6 months, it's been more of a flattish number kind of thing, right? A 5% return, that too, which has come in the last 1 month, is the return for the full year. So effectively, last 1 year, markets has been flattish, especially from the highs that it witnessed last year. And we think the market can build up on this now. Once the tariff issue is behind us, investor focus will move towards domestic growth where things are picking up, and that will be a good time for Indian equity markets to perform. After a long gap, you see on a relative basis, India has underperformed significantly to many of the peer groups. If you see the 6 months data, we are between 5 to 10%. You see most of the others are 15, 18, 20%. There has been a decent rally in the last 6 months in most of the markets. India, unfortunately, has lost out. And that is because one, it was expensive. There was slowdown, which is now picking up, but there is now tariff uncertainty. Once that is done, then I think this whole performance will change. Uh, and it will come back to somewhere what we have done in the last 2 to 3 years, where you have a good 40-50% kind of return, which is among the top quarter. Like, but in 2-3 markets, India would be among the relative better performing markets from that sense. So this is broadly what we feel holds for the market. Besides this, there is also one risk which is there in the market, which is that of the currency risk. We all know in the last few months, INR has moved from 85, it has gone all the way to 89, 88, 89 levels, and is holding up there. Is there any specific reason for INR depreciation? No, there is no specific reason for INR depreciation because our forex reserves are the same. There's not much that has changed from the forex reserve perspective. Economic movement, economic growth has picked up. The government policies are similar. So fundamentally, there was no reason for this 5% rupee depreciation to happen in over the last 1 year, right? Looks like the RBI or the government of India has allowed the rupee to depreciate because they also need to compensate the exporters for the tariffs that is going to come in. So maybe 8-9 months back, the expectation would be we'll have a 10-15% tariff. Now, if the tariff is going to be 20-25%, then indirectly, somehow you have to compensate the exporters for this, and hence the RBI has allowed the rupee to depreciate. Uh, I don't expect a further rupee depreciation because normally the rupee is a stronger currency these days compared to what it was a decade back or 2 decades back. And hence, I think bulk of the movement for the currency is now behind us. Now, the only risk to this is that if the dollar index appreciates. So, as we all know, first time when rupee went to 88 level, it was because of dollar. The dollar index, which was 103 level when Trump got elected, went to a high of 111. And all other currencies pegged to dollar versus dollar depreciated. This time around, the dollar index is where it is 98, 99, 100 levels kind of thing, but that INR has depreciated, right? So it's more of INR depreciation than dollar. Now, over Trump has got elected, the US dollar has been weaker. And I'm told, and this is what the policymakers of US mentioned, that the Trump wanted a stronger dollar. This would help him negate the inflation impact of the tariff that he was going to put. Now, instead of appreciating, the dollar net net today is depreciated, which means that the double whammy for the US. I'm thinking it is very likely that the Trump might do something to see that the dollar appreciates. He might make some policy announcements, he might talk the dollar up, or he might try to do something so that they see a stronger dollar. If that happens, then INR has a risk of going to beyond 88, 89 levels and maybe cross 90, 91 kind of level. And this is the period when dollar appreciates, global liquidity or global money moves more towards dollar assets than moving towards emerging markets or emerging market currencies. And hence, that is a period where we don't see much of FI flows coming in. This can be another near-term risk to the market. Coming to the flows have been, as we all know, patchy over the last 12 months. Having said that, October was still a decent month for the markets. We saw a net buying by FIs versus previous 3 months where there was a total gross net outflow from the market. But this is just one side of the coin. The other side of the coin is that we have seen a very vibrant IPO market. Every week, one or two good IPOs are coming in. Every day, there is one or two IPOs that is opening up, and that is sucking away good amount of liquidity. So I can say almost 40-50% of the monthly SIP inflows that is coming into India is going towards these IPOs or these QIPs. And hence, uh, while on one side we see good inflows, we are seeing good supply also. And that is also meant that the market remains range bound. But I think once this tariff issue gets decided, the FI flows should start to come back. India is no longer an expensive market the way it used to be. India always has traded expensive. The call in India always has been whether it is more expensive or less expensive. And today, we are fairly priced, or we are like near close to average. If you see the data here, this data tends to slightly move up because this is still 1 year forward number, and we are already in November. Come December and Jan will move ahead from FY27 numbers to FY28, because then FY27 will become the current year. And on that basis, the Nifty would be trading at closer to 10-year average, or slightly lower than the 10-year average. And that is a decent level for somebody to consider Indian equities. And I feel that the FI inflow should start to come back. Bearing the currency risk, I don't see any other reason why FI inflow should not come back, because domestically we are doing fine, and India is no longer that expensive market the way it was a year back. It has also happened that other markets are doing better returns, so there is no compelling reason for FIs to come into India. But that can change quickly. We all know that when India starts to perform and people have already made money in other markets, they will tend to book profits there and come to India the way they have done in India over the last 12 months. So there is a fair possibility that we can get a decent amount of FI inflows, and that will also help the market. We need some triggers in the market. The near-term trigger, besides tariff, is something from the government side. I'm sure the government is prepared to handle the tariff uncertainty or the tariff outcome, whatever the outcome is. So I believe the Modi government will take appropriate steps. This time it could be more of sectoral, uh, you can say, impact, or sectoral measures that they will take specifically for the companies or sectors which are getting more impacted by the tariff, instead of having a blanket kind of a thing the way they did for the tax or the way they did for the GST. But nevertheless, that is going to be something which is going to be a positive trigger for the markets. And the other trigger would be in from Jan onwards, we start to look at FY28 numbers, wherein we'll build in an acceleration. So uh, FY26 GDP is going to be better than 25. I feel FY27 GDP is going to be better than 26. So markets start to making those numbers also. And that would be a good reason for the markets to move in. Coming to sectoral bets, has our sectoral preferences changed? Broadly, no. We are more or less where we are, in spite of, you can say, uncertainties regarding the tariffs. We continue to be positive on the metals front. We added more of metal exposure into our portfolio. We have reduced a bit of IT. IT is something where we are. IT index has been a laggard. It's closer to the 10-year average. We Because of the high base, the larger IT company growth rate has got impacted. And as we have witnessed in the past, whichever sector or company where the growth rate gets impacted, the sector gets derated. And that is something which is happening in the IT sector right now. So we have trimmed our IT exposure. We have used our money to buy more of metals. We have bought more of pharma. Since the story is all about domestic growth, we continue to stay positive on the capital goods and the auto ink space in India. And financials continues to be the highest weightage in the most of the portfolios. Within financials also, we prefer larger banks versus smaller banks. We prefer NBFCs over banks, and we also have recently, though we had some exposure before, but we also added recently the non-fund based financial stocks and something related to markets like a broking company or an AMC company or a wealth management company kind of thing. So this is something that we have done in our portfolios. Uh, we are not very big fan of PSU companies. Because of that, we have not been able to, you can say, participate or take any decent exposure into the defense sector, which is something which has been one of the best performing sectors of the last 12-15 months, and for the right reasons. We are relooking at this sector right now. We have already made a first small allocation into a defense company, and we'll want to build up onto that portfolio. We are also much more open than what we were a year back on new age companies, the fintech companies, the dot-com companies. Earlier, these companies were loss-making companies, cash burning companies. Our preference even now is towards profitable companies or companies which are at least not burning cash. The valuation for this sector will remain high. We are now okay with that. Having said that, we'll not just blindly buy anything. We'll still try to get a decent relative valuation company, where on a relative basis the company is much better off. Plus, a company which is not burning cash. So that is means some of the sectoral bets and sectoral preferences changes that we have witnessed over the last 1 or 2 months. Going ahead, I think we'll add more of pharma in our portfolio. We could add some of bit of chemicals because that sector is now looking good. Metals we have already added, so that's not something that we are now going to further incrementally add. And it's going to be a bottom-up investment approach that we will continue to have. So that's broadly on the market side and what we expect out of markets. I think if somebody is looking to deploy money in the market, the best strategy would be to stagger it over the next 1 2 months. If you don't want to put it one way lump sum, then do it over the next 1 2 months. Don't stagger over the next 6 12 months. Is what our suggestion is, because if the tariff disappoints, the market is going to correct. It will most likely correct in the month of November or in December. If the market had to move up, that will also maybe the first leg of that will happen in the current 1 or 2 months also, right? So good, bad, or ugly, whatever it is, time to benefit out of that is now. After the event has done and after the market has already moved, then it becomes too late, right? So, if you want to take advantage of that, then stagger it over the next 1 2 months. Do it right now. Maybe some chunk goes in November and something goes in December, mid December, and that should be the advice that we have given to our clients to come in if somebody is looking to add on to the equity exposure or looking to build up a new equity portfolio per se. Markets, according to us, should give you double-digit returns. Mid-teens is what we feel is sustainable, though not linear, but sustainable kind of equity returns Indian markets can still give, and which is a good returns based on the options and other asset classes. So I know last 1 year gold has been rocking, and so has been other precious metals, but that rocking also has happened once in 10 years kind of thing, right? So that also is a good investment, not to say no, but yeah, equity market at least has an option that it can give you a much better return. Uh, in the past 2 3 years, people have made 30, 40, 50% kind of return. That doesn't seem to be the scenario right away. But in equity market, the good thing is that at least there's a possibility of the returns to come in. Tomorrow, if the tariff in India is only 10%, markets will rally 10%, right? And you make a 10% return in 1 month flat. Or Modi makes any new announcement to revive, to further accelerate growth or something, then that will be a good trigger for the market. The way it happened with GST. Uh, in August, he announced. Before that, there was nothing about the GST chatter in the media, and in September, it got implemented. Right, that's the way the government has been proactively working, and there can be further news and further, you can say, reforms or action or news flows or whatever, whichever word you use for it, from the government side to pump up the economy, because the intention of the government is very clear. They want growth rates exceeding 7 8%. They don't want growth rate in India to be around the 4 to 5%, because then at that level we can't sustain the population growth that we have, or the aspirational growth that we have, right? So that's broadly what the market is. So, in to conclude, positive on the markets based on domestic data points where things are accelerating and getting better. Worry remains global only, wherein incrementally the news flow is turning positive on the tariff side. And if the US dollar doesn't have a run, or the dollar is stable, which means the INR also is stable, then that risk also gets mitigated to a certain extent. And hence, overall, markets which have been flattish for a year now can start to deliver returns from, so maybe even as soon as current month onwards, right? So that's broadly uh, the market view is. I'm sure you guys would have some queries on markets, on portfolios. Maybe we can now open up a Q&A. You can post in your queries in the chat box, and I will be happy to address them. Due to regulatory and compliance reasons, we don't comment on individual stock names, and hence please resist from asking those questions. But any broad macro or micro outlook or any view on the markets, happy to address them now.
Yes, sir. So the first question would be your short-term outlook on all three PMS strategies: all cap, diversified, and emerging opportunities.
See, the short-term outlook on three in the very near term, the short-term outlook will be dependent on the market outlook because this all the three portfolios run the same philosophy of non-benchmark portfolios and value-conscious style of investing and bottoms-up investment approach, and hence these are all very differentiated portfolios versus what the benchmark would be. If market were to move ahead of and rally over the next few months, then I expect all the three portfolios to do better than the markets. uh, I feel to start with, large caps can do well in the next immediate next 1 or 2 months, and then the mid and small cap will play a catch-up rally. So maybe very near term, the all cap portfolio can give you a slightly better return than others, and then the other portfolio will catch up that way. So, but it's not going to be something which is very significantly different because if market were to rally and say large cap rally 10%, it won't happen. The large cap is plus 10 and mid cap is flat. If large cap is 10, then mid cap is going to be 5, 6, 7% kind of thing, which eventually they'll catch up. So that's broadly what the near-term outlook on the PMS is. There has been some degree of underperformance in the performance over the last 12 months. This is the first time in the 7-year history of Abacus we have seen that. It has been due multiple reasons. We have not been aggressive in the market. There's been some cash drag. We don't have defense, pharma, the momentum sector that we have, and some of our holdings, which have been multi-bagger holdings for us, or the top 10 holdings, had some of the client specific or company specific issues which has impacted the near-term performance, and some stocks are just taking a breather. For example, some of our top holdings like General Stainless or say Iron Exchange in some portfolios of that matter, even IFL Finance, they're all taking a breather. They have done well for us over the last 3 years. Just the way we see batteries getting recharged, something like that. So it's a combination of factors that has affected us. We have made portfolio changes, not drastic, but we have, since I mentioned that we are today much more confident on market than what we were last year. We have made some positive changes in the portfolio and will continue to do that. And hence, uh, over the next 12 months, I expect all the three strategies to do better and generate the alpha that we are seeking for in all the three names.
Okay, the next question is, can you share earnings review for Q2 so far amid GST disruption, and when do you see earnings to pick up?
So the third quarter numbers should definitely be good based on the festive demand kind of thing. Selectively, 2Q numbers have been selective because there also has been deferment of demand because people waited for a month before the new GST rates came in. So there was a month or so wherein demand got pushed off because of GST, right? And there are various sectors and companies where performance has been impacted because the exports to US are virtually at a standstill. Broadly, financial sector has done well. Growth has slightly picked up. The NPA numbers are better than what it was in the previous quarter or in the previous year. So that sector has done well. IT sector has been in line overall. Pharma, so far the results that have come in, companies have reported broadly in line kind of performance. Chemicals has been a mixed bag. Some chemical companies have done well, some chemical companies have not done well because of the extended monsoon in India this year. Initially, the agrochemical space did well, but then there was stock returns also that has come in because of extended monsoon. Farmers have not used the full quota of agrochemicals they normally use in a year. Similarly, AC sales, because of extended monsoon, AC sales have not been that great, or this season has not been that great versus the previous year. So this quarter numbers for AC sales have not been that good, but household brown goods or a small electronic item have seen robust growth in the current year or in the current quarter versus the previous quarter. So it's been a mixed bag kind of thing. We are already seeing earnings growth picking up. Let me see if I have that slide, Dami. Uh, Compared to what it was 2, 3 months back, earnings growth has started to pick up, and I expect this to continue. The 3Q should be even better than what the 2Q numbers is. I don't have the earnings growth because I think the earnings season is still ongoing. It's 13 today, and bulk of the companies will be reporting this month, or sorry, this week, and maybe in the next month they call we can share exact details to how the earnings season has been in 2Q and maybe what's the outlook for 3Q looks like. But broadly, as we speak right now, for the portfolio companies, mostly we expect 3Q to be better than even 2Q. And 2Q also, portfolio companies have seen growth. And on an aggregate level, the portfolio earnings growth has been in closer to say mid double digits.
Okay. The next question is fund managers are buying high PE IPOs despite high valuations. Your view on this?
So as you guys will be aware, we are very selective in the IPOs. We on an average will be investing in one or two IPOs out of the 10 IPOs that come in, and we continue to maintain that stand. We have shied away from very high expensive IPOs that you could be indirectly referring to. We have not been investing. Having said that, we have selectively invested in one or two new age IPOs that are coming. And here the valuation is higher than the traditional companies, but it is expected. But these are profitable companies, and hence we are comfortable to look at these names. So we have bought some new age IPOs in the recent months, but the view remains the same. We'll completely avoid overhyped or uh, too aggressive valuation IPOs in the market the way we have been doing it over the last several years now.
Okay. The next question is how rupee depreciation will have an impact on earnings.
So it has a positive impact on all the exporters, IT and pharma, and also all the capital goods, the chemical companies which are all exporting to US or European countries. That way, that they all get positively impacted. People who get negative impacted would be importers like oil or raw material import from China gets more expensive kind of scenario. But I think the rupee benefits Nifty earnings, then it dampens the rupee earnings because uh, there's a decent margin uptick that comes in. So the rupee depreciation that we have got so far, the full impact of that is not yet visible because most of the companies which are regular exporters, they hedge the currency. They hedge the currency anywhere between 3 to 12 months forward, and hence they will get to reap the full benefit of that. But 3Q and 4Q should be the time when the benefit of the currency depreciation starts to show on numbers. Beyond that, I don't think the currency has, in a way, impacted much of the corporate earnings. IT and pharma remains the best sector, which has benefited from this currency that way.
Okay. The next question is your views on current market scenario for US.
We don't track in US equities. We don't have a view on them. Unfortunately, I won't. I'm not the right person to make any view or any comment on the US market because we are not experts there. We don't track that market. So sorry for that.
Okay. Considering a 3-year time horizon, what would be the best performing sectors you would recommend?
From a 3 year horizon, I think pharma sector should do well, chemical sector should do well, uh, engineering sector should do well, EPC sector should do well. In the near term, I'm expecting metal sectors to do well, and overall, the first three four sectors that I mentioned should do well because they are all uh, trading today closer to the bottom or below average levels, and where the outlook is turning positive. And once the outlook is definitely positive, then the market tends to read these sectors. And that is the reason we feel that the sectors that can do well over the next 3 years.
Okay, so this is the last question. Your views about the AI bubble and its effects on Indian market.
Sure. So the question has already assumed that the AI is a bubble, and which may or may not be the scenario. That's definitely a buzzword right now, and the buzzword is not without a reason. Our lives on a daily basis are getting impacted or getting better or impacted due to AI. As we speak, AI is come in various forms already into our lives. So it's not just the digital content or the Google or the Chat GPT that we use. In fact, now when you open a PDF document, also Acrobat has an ad in the Acrobat Reader, which earlier we never thought we'll have an ad inside an application. We thought we'll see ads only on Netflix or YouTube or only when using an app, but not just a document reader. But we are seeing ads in that also, and those ads are getting more and more relevant based on your past search history, and that is all coming from AI, right? So the investment in AI is for real. Company, it's something what it was for digital post COVID, where most companies wanted to go digital and go online. today every company wants to embrace AI, and that's the fact of the matter. So I don't think it's a bubble. There could be some pockets, or there could be some companies where valuations are too high, and that could be, uh, you can say, a bubble area per se. But otherwise, broadly, this is going to be the mainstream sector of investments for the next few years. This is where bulk of the money is going to go, and that is what the future is all about. Very the way iPhones and digital content has become part of your life, AI is going to be part of your life in the next 2 to 3 years, not even 5 years or 10 years later. It is already, but within few years of its launch or its getting prominence, it has entered into our life in a meaningful way, right? So that's where the future is. EV might still take 10 years, but AI might take just 1 or 2 years, and hence the hype or the news flow around AI is for real. It's not something that is a bubble territory. We have a positive view on AI. Unfortunately, Indian equity markets doesn't have much of direct place, or in that matter even indirect place to cash into the AI. IT companies will all say that yeah, they do some kind of AI work, they help the companies. Most of the companies that we speak to, they say that they are using AI to benefit by putting in a bot or a chat box powered by AI or FAQs or something. So companies have also started to embrace this AI, and I'm pretty sure that uh, we'll definitely benefit out of this by the way of better productivity. What price you pay for this is something that is everybody's individual perspective. Since India doesn't have much of AI space, we haven't dwelled too much into this. But at least for now, doesn't look like a bubble to me that way. Some pockets could be, but not. It's not a hype in that sense.
Okay, sir. So with this, we can conclude today's call. Thank you, Aman sir, and thank you, participants, for joining us on this Thursday evening. We look forward to connecting with you again next month. Thank you.
So thanks everyone.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing. Performance and references to returns are indicative and does not guarantee any returns. Investor discretion is advised. This video is neither a general offer nor solicitation to avail the service of investment from the CB registered intermediary under the services offered by Abacus, nor is it an offer to sell or a generally solicit an offer to become an investor in the services offered by the Abacus. The delivery of this video at any time does not imply that information herein is correct as of any time subsequent to its date. The contents of this video are provisional and may be subject to change.